So if you've got a retirement account, a 401k, or really any money in the stock market, you almost definitely own a fund that tracks the S&P 500. For years, we've thought of it as the bedrock of a safe, diversified portfolio. But here's the thing, that bedrock has a secret, and it's hiding in plain sight, quietly turning your safe investment into a massive bet on just one industry. Let's dig into what's really going on here. Okay, look at this number. 40%. It's not just some random statistic. It represents a huge shift in the market that's affecting pretty much every retirement account out there. And yeah, that probably includes yours, whether you know it or not. So what on earth does this number mean? Well, it means that nearly half of your supposedly diversified S&P 500 fund now lives and dies by the success of just 10 companies. 10. And the one thing that connects almost all of them, a massive, all-in bet on artificial intelligence. So without you lifting a finger, your quiet retirement fund has morphed into a high-stakes, concentrated bet on AI. So how did this happen? I mean, how did an index that's famous for representing the broad American economy get so top-heavy with just a handful of tech companies? Well, the answer isn't some secret plot. It's actually built right into the DNA of the index itself. The scale of this is just wow. Take a look at this. Just 5 companies, we're talking Nvidia, Microsoft, Apple, Alphabet, and Amazon, now make up almost a third of the entire index's value. Just let that sink in. 5 names have nearly as much influence as the other 495 companies combined. You know, for decades, we were all told the S&P 500 was a balanced investment in the whole US economy. But that idea, it's pretty much broken now. This quote from one market analyst says it all. The old way of thinking has obscured the fact that it's a technology megacap fund today. And megacap, by the way, that's just a fancy word for the absolute biggest of the big companies. We're talking trillions of dollars in value. And right now, that's tech. Okay, so what is the actual mechanism driving this huge shift? It's not some kind of backroom deal. The reason is surprisingly simple, and it's been part of the S&P 500's design the whole time, just waiting for something like the AI boom to come along and kick it into overdrive. The S&P 500 is what's called a market cap weighted index. Now that sounds complicated, but all it really means is that the bigger a company is, its total value on the stock market, the bigger its piece of the pie is in the index. So as a company gets bigger, its influence over the S&P 500's performance gets bigger too. Simple as that. And this design creates this incredibly powerful feedback loop. It goes like this. Everyone gets super excited about AI, which drives up a company's stock price. That makes its market cap bigger, which automatically increases its weight in the S&P 500. Then, every S&P 500 fund has to buy more of that stock to stay balanced, which, you guessed it, pushes the price even higher. And around we go. And this chart, this is the result of that feedback loop. It's kind of wild. On the left, you've got one single company, Nvidia, making up about 7% of the entire S&P 500. And on the right, that's the combined weight of the bottom 224 companies in the index. That's right, one AI chip company now has as much sway as nearly half the companies in the entire fund. So, naturally, this all leads to the billion-dollar question, right? Is this incredible concentration a dangerous bubble that's just waiting to pop? Or is it simply what happens during a massive economic boom, a new industrial revolution powered by AI? Well, the experts are really split on this one. Okay, so in one corner, you've got the argument for risk. The critics are saying, hey, the S&P 500 isn't really diversified anymore. One bad quarter from just one or two of these giants could drag the whole market down. That old set it and forget it strategy, maybe not so safe anymore. But in the other corner, you have people who see this as a sign of incredible strength. They're arguing like AI and tech are the future. This isn't a bubble, it's a fourth industrial revolution. As one analyst put it, you want to own the Ferrari in the left lane. But maybe it's not so black and white. Jeff Bezos has this really interesting take. He talks about industrial bubbles. They're different from purely financial ones. The idea is, even if some of these high-flying companies eventually fail, the race to innovate creates real, lasting inventions that end up benefiting everybody. So when the dust finally settles, we're all left with some world-changing technology. But this intense concentration of money doesn't just stay inside our 401ks. It has these huge ripple effects across the entire economy, and it's starting to raise some serious questions about what some are calling a new AI wealth gap. If you look back at the history of big tech revolutions, you start to see a pretty clear pattern. During the Industrial Revolution, who got rich? The owners of the factories. During the internet boom, who made the fortunes? The founders of the platforms we all use. So that leads to the really critical question on this slide. Will the AI revolution just follow the same script, putting wealth in the hands of the people who own the AI? And here's the absolute crucial difference. Millions of us are going to use AI tools to be more productive, to do our jobs better, but there's a world of difference between being a user and being an owner. Think of it this way. Using an iPhone doesn't make you an Apple shareholder. History shows that the biggest rewards don't go to the people using the tools, they go to the people who own the systems that create them. Okay, so all of this brings us right back to you and your money. Now that you know your S&P 500 fund is basically a concentrated bet on AI, what can you actually do about it? How do you take back a little control of your financial future in this new world? So, one tool you should know about is the equal-weighted S&P 500 fund. The name kind of says it all. Instead of weighting companies by size, it gives every single one of the 500 companies the exact same weight. This means you're way less exposed to those few tech giants. Now, the trade-off is you might miss out on some of those explosive gains when the big guys are soaring, but it also gives you more of a cushion if those same giants start to fall. So, what are the big takeaways from all this? Well, first, and this is the most important one, know what you own. Log into your retirement account and actually look under the hood. See how much is tied up in these top tech names. Second, maybe it's time to reevaluate what diversification really means to you now. And third, be honest about your time horizon. If retirement is decades away, maybe you can handle more risk. If it's just around the corner, you might want to think a little more defensively. At the end of the day, the big secret of the S&P 500 is that it has already made a decision for you. You're an investor in the AI revolution, whether you planned on it or not. You can't really opt out anymore. So the real question for your financial future is no longer if you'll be a part of it, but how you choose to be.